So thank you for coming. My name is Noshi. Today, I'll explain to you how I go about daily and then doing my trading, and the day before, like in the evening, how I prepare, and then what I do during the day, and then how I communicate with my members through different messages. We have also implemented Telegram. So if you download the Telegram, we will send you the trade messages through Telegram. It's very instantaneous, and email. So we deliver messages through email and Telegram. So on your screen is a code. I came to know about this code 15 years ago when uh, I met a person named Chief who was in one of the trading group I belong to. So at that time I was learning the trading, and I was trying to learn all kinds of trading. I did not know. I did not know anything. I'm still learning. So at that time, he pointed out to me that Noshi, you need to practice one kick 10,000 times instead of just practicing 10,000 kick once. So this quote by Bruce Lee. So I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. And this quote is stuck with me because also when I was growing up, when I was a little boy, I grew up in India in a small village. I was brought by my maternal uncle for 7 years. So he was very thin man, but very strong, and only one eye from the young age. So one day he just stopped. So he used to communicate with me suddenly. He just stopped while he's walking. He loved to walk, and then I was walking with him, and then he stopped, and then he turned around and he raised his fist up in the towards me, towards my face, and then something happened to him, and he wanted to communicate. So he said, "Noshi, you will not be a big man when you grow up. You will not be a big man." So I already know. So there will be a time when you will be in a situation, you will be cornered uh, by someone who will be 5 times bigger than you. So uh, you then he raised his fist again and he said that you can take the beating, but remember you will get one opportunity to bring that man down, and that's the time. So you better avail that opportunity. So his quote when I was a little 10-year-old um, boy, 10, 11, and this Bruce Lee, so stick with me. There is no sound. I think you have a problem. I have already started uh, my session. Yeah, shoot him. So there was a time when I got stuck. There was a scenario where I did get stuck. I mean, many other scenarios. So I did get stuck in one scenario, and I had to bring that big man down. So I remembered. So I suddenly, when I was in that situation, uh, my uncle's teaching reminded me, and this Bruce Lee quote. So practice one kick 10,000 times. So when you practice one kick 10,000 times, then the things become easy. So things really become easy because you see it every day, the same thing again and again, whether it's a dog or it's a cat, a symbol on the chart, you can see what's happening. They do uh, behave the same way. Also, um, so Chief also, so when I was learning from Chief through email, so he used to communicate, and one day so I was saying, Chief, teach me something. So he sent me email, and he said, long Home Depot 1,000 shares here. So when I opened the chart, I look at the Home Depot, and I didn't understand what he was looking at. So I said, okay. And then 3 days later, he sent me another email, $3,000 profit, LOL. So I opened the chart and said, damn, what happened in the Home Depot? So when I look at it, the Home Depot was up and he was out. So I said, Chief, I missed it. Send me another one. So he said, okay, LOL. So a few days later, he sent me another symbol. I do remember Home Depot for sure. That was his uh, the symbol. And then I don't know what he sent me later. So he sent me again 1,000 share here, and then I couldn't figure it out. So again, a few days later, he said, "LOL, this much profit." So then I asked him, Chief, you need to teach me. What are you looking at? So he said, well, there's a certain way trading is done, a certain way the charts are read. There are dinosaurs, so big boys. So he talked about the dinosaurs. So he said, learn to detect the dinosaurs. And then he gave me this quote. I don't know if this is, I wrote it down, whether it's from the internet or what I remembered what he said, but this is what I remember him saying: the dinosaurs can run but cannot hide their footprints. So dinosaurs are the big boys. So if you think about the dinosaurs are these, we all know the institutional players, the hedge fund, the sovereign fund, the pension fund, the high frequency traders, they influence the size, they have big pocket. They are doing the program trading, they have complex trading strategies, so they have all the resources in the world, and we are just trying to follow. So follow. If we can capture a little bit of move, maybe 60% in between, if we are swing traders, then we will be well off. So creating ripples in the market, these big boys. Also, I ordered some books. At that time, I don't know if YouTube was there. I'm talking 15 years ago. So I ordered some books and I'm reading all the kinds of chart patterns and all kinds of indicators and Bollinger Band and this and that and MACD and 80x and then DMI and stochastic, all kinds of things I was trying to learn. So again, so during my conversation, so I asked him, Chief, so many things, how can I learn everything? So again, he said that you don't need to learn everything. Just master few key chart patterns. So again, relate this key chart patterns with the Bruce Lee quote. So master the key chart pattern. So the criteria, if you look at the criteria for the chart pattern, you know, what do you want to learn? There's so many things in the world, you cannot learn everything. Same way for the trading. So what do you want to learn? Where you can learn easily and create an edge and be comfortable. So the chart, so the criteria could be the charts which are reliable. So the pattern which are reliable, which you can rely on, which is consistent, appear again and again. So quite often have a certain risk and reward. So all these criterias, if you start writing down that this is my criteria, and then what fits in this criteria. So you will come to identify key chart patterns, maybe 1 dozen, 2 dozens, and then you master those. So so key chart patterns, which are reliable, which appear again and again, which have a risk to reward, proper risk to reward. They appear again and again. So there could be a chart pattern which is very reliable, but it appears only once a year. So you can master that, but it appears only once a year. So you have to wait for 1 year, and maybe you can find it. Maybe you missed it, and maybe you found it, you did not miss it, but it turned out to be a loser. So you don't want to do that. So just focus on few key chart patterns and then practice like Bruce Lee. So once you do that, then you should be able to create a low risk trade idea system. So think about it, low risk trade idea system. So what is the definition? So this definition I got from someone, again, another teacher, another mentor. So think about the low risk trade area. Low risk trade area doesn't mean that you only lose 5 cents in the trade. Low risk trade idea. So this definition have a lot of meaning into it. So think about it. A low risk trade idea is an idea with a positive expectancy that's traded at an exposure level that allows you to survive the worst possible contingency. So this keyword. So there are many keywords. Worst possible contingency, exposure level, positive expectancy, short run, so that you can achieve the long-term expectancy of the system. So in other words, you have a certain portfolio size, you have a certain tolerance level and risk that you are willing to lose this much in one trade. So once you know that you're willing to lose this much in one trade and you have a portfolio, then even if you suffer a drawdown in the short run, on the long run, you will come out ahead. So it's like playing a game, tossing the coin. So tossing the coin, but you have an edge. You know that I. It doesn't matter if the coin is tossed 1,000 times. I will be the winner, whether head or tail. So if you know that you will be the winner, just like casino, they know doesn't matter, the house will always win. So if you develop the system that you're looking for that trade idea every day, which you know you have to take. So if you cherry pick, then so you will miss um, certain profitable trade. So it should be the trade system should be such that you don't even have to cherry pick that should I take this trade or shouldn't take the trade. You look at it, it takes 30 seconds to decide whether this trade demands further merit, like further your time, and you put it in a separate watch list that it requires your attention, or it doesn't need, you just ignore it. So it should be so tight. The trading system should be so tight that it generates few trades that you look at it and you know in 30 seconds that this trade is the one which needs your further attention, and then you can work on it, spend some time, and then you have a way of taking action. So that's another topic. How do you take action? So in other words, you need to craft your trading plan, your trading system, your trading ideas, how you generate, and then the other part is the execution. So executing that plan. So execution, people can write their trading plan all day long. I mean, you can maybe Google right now and find somebody's trading plan, but you cannot execute it. So yeah, all this is getting recorded, so I will post in the YouTube channel. So you can get the trading plan by anyone, but you have to develop yourself inside, matching that person who has developed the trading plan. So it's kind of hard to execute. You need to in this trading low risk trading ideas, there are certain rules. So you're looking for the chart patterns, whatever chart pattern, the indicator. It could be a chart pattern in combination with an indicator, in combination with the volume. So market analysis is combination. So the trading system is a combination of all the indicators you're using, the chart pattern you're using, the volume analysis you're doing, all combined becomes a trading system, and then you're executing it. So and then when you're executing it, you're following certain rules, certain checklists, and then playing the game perfectly every day, laser focus executing it. So you're capitalizing on those low risk trade ideas. So when you do that, you develop an edge in the market. So so we need to ask ourselves what edge we have in the market, because without having an edge, we are just a mediocre trader. So we need to have an edge. Edge could be if you start writing down the edge you have, it could be as simple as going to bed early and waking up early, 1 hour early. That's, you have an edge on other traders who don't do that. eating healthy food, taking, exercising, staying away from vices, not partying, not drinking alcohol. All that you have an edge. Not having any stress. If you have a stress, you take care of your stress, knowing that you are ready for the market. So these little things deep down, you create an edge in the market. And then when you're executing it, you are executing it with the clear head. So being very precise and executing trade ideas flawlessly. So you're waking up, turning on your computers, everything is ready. You have done your homework, and then not only you done your homework. So when you do your homework, so I have another presentation on debriefing, what you do after market is closed, how you close the loop. So you closing the loop at nighttime, in the evening, by doing certain things, by taking by looking at all the things which happen. So I'll teach you that. Then when you wake up in the morning, you have to open the loop. So opening a loop and then closing the loop. So how do you open the loop? If you open the loop in a haphazard way, uh, when when the market is already running, and then you come to the market, how are you opening the loop? You will open the loop in a haphazard way, and you don't know what is happening in the market. So opening the loop properly and then closing the loop properly. So closing the loop in the evening by doing the debriefing, going through the whole day, what you did, visualizing what you saw in the trade, which trade worked out, which didn't work out, what you saw. So it's like storing the image of that chart. When you see the chart, you now have to store it in your brain, so that later when you see the same chart, you can match it. You saw that before. So think about it. Only way you can do it is going back, taking 10-15 minutes after the market, and going through your mistakes, going through your plan, going through what happened in the market, and what mistakes you did, etc., and what you will do next tomorrow to improve, and then which candidates you will be looking at next day. So executing trade ideas flawlessly, and then going through debriefing at the end of the day. So there are 9,000 stocks. So I don't look at those 9,000 stocks. I have a limited um, I cannot focus on 9,000 stocks. I'm just looking for 150 or 200 stocks. So I have prepared a list of 250 stocks, which I call it hardcore stocks. So these are the stocks based on certain criteria. And I don't want to, when the market is running, I need to have those stocks in front of me. So like Apple, Baba, Baidu, Nvidia, AMD, Home Depot and Caterpillar and John Deere or Meta, these kind of stocks. So they are there. So every day I know they are there. So 250 stocks. Then there are certain stocks which I need to look at because of the market analysis. So I call it core stock. So they sometimes I trade them, sometimes they move, sometimes don't, like GE, etc. And then there are non-core stocks. I call them, like I need to have them in my database, like Verizon and AT&T, because they are part of the certain indices. So I need to keep them. Small cap stocks only when the market is bullish. Right now market is very weak. So market is very weak, so I'm not doing any small cap stock. So small cap stocks, this build up, and then let's just shrink. It goes to almost zero. I don't pay attention to small cap stocks when the market is bearish. I don't just they get hit 50%, 25%, 40%, like that. So I don't trade small cap stock. They are very volatile. Only when the market is bullish. Indices ETF like DIA, SPY, TQQ, QQQ, IWM, I take a look at it. I sometimes trade. Semiconductor ETF, I pay attention to them. Gold and silver ETFs, and then sometimes inverse ETFs. I keep them when the market is. I can look at, if the market is going down, then these inverse ETFs are going up. So I see if I can read something clear, maybe to understand the market, maybe to trade. So inverse ETF. But my main focus every day are the hardcore stock. There's always something moving during the day if you prepare your 250 stocks. So the criteria for candidates is, so I do the market analysis. Then the criteria for these candidates, which for liquidity. They are liquid, they are volatile. I can do the proper technical analysis, meaning I have 2 years of data on it. So I cannot read the chart if the if if it's an IPO, how can I read the chart? If I'm trading based on chart, how can I read the stock which doesn't have a history, at least 2 years of history? So I can apply some technical analysis. I can read the chart. I can see what was the past behavior, and then I can read some fundamental analysis somewhere. Option analysis. If I'm trading doing options, then these symbols should have a proper option. Sometimes the options, the stocks looking great, but the options are bad. The spread is so wide, there's no volume. It's just crazy. It looks like as if nobody's trading option on those stocks. So I keep them. Sometimes I keep them just if I have to trade shares, but most of the stocks are already filtered based on the option. Then the sector analysis. So which sectors, which one is getting clobbered? So pay attention to the sectors, any news and catalysts, any news out there, price pattern. So this is my main thing: price pattern, chart pattern, price pattern. I pay attention to that. I have done that's all I have done 15 years, price pattern. Now another important, not only the price pattern but the volume pattern is very important. So I teach separately about the volume. I'll talk to you a little bit about it. So the volume pattern, so how the volume is when the stock is moving, where is the volume? So maybe there is an anomaly going on. The stock is moving up, but there is no volume, or the stock is going down and there is no volume. So what is the volume? Where's the absolute volume? So I need to know what is an average volume, what is the volume right now, what is the relative volume. So I do the analysis on the relative volume, which means the stock which is trading at, at that certain period. Let's say I am in a Pacific zone. So let's say it is right now 7 o'clock, 7 a.m. So 30 minutes has gone by. So based on the historic data I have, my system tells me what is the relative volume percentage. So during that 30-minute time segment, so there are 390 minutes in a day. So if a stock trades 1 million per day, then divide by 390 minutes. So you get per minute volume. So per minute volume you get, and then you multiply by 30 minutes. So then you know on average this stock trades should be trading these many shares and only 30-minute path. So if the shares are higher, maybe there is something going on. So then you look at pay attention, you look at the weekly chart, you look at the daily chart, then you can go as low as a 5-minute chart to time your entry and then analyze it based on the risk and reward ratio. Maybe the move is over, maybe there's enough move. So enough move, maybe the weekly chart is telling us there is a lot of move available in the stock, even though day chart is oversold or overbought, or the hourly chart is oversold, overbought, but the weekly chart is saying that okay, this stock is crashing. Maybe it gives you some idea on the upcoming move. Now, price and volume filter. So I use uh, price and volume filter in my trading. So price filters, so all the stocks are already filtered based on the price. So I don't trade any stock which is like 10 below $10. So sometimes the stock they were $50 stock and now they are $5 stock. So I don't trade these smaller stocks. So I've already filtered them. Volume filter. So I apply volume filter. So absolute volume. So if the stock is trading 1 million per share per day, then I get the alert for the absolute volume. It's already trading 150% of the absolute volume. So something is going on. Just for the information, what is the relative volume? Just for my information, that it should be trading this many shares at this time on average, and it's already surpassing 200, 300%. But that is not just that is not only the criteria that if the volume is high, then something will get bought or sold. So people get traders get trapped in the volume also. They look for the volume spike and they buy it, and then everything dies down, or they look for the volume to the downside and then the game is over. They were the last ones. So So, but I apply volume filters, average true range filter. So if the stock is trading $2 on average, and it right now is already trading $2.50, so I pay attention to that. Any change, percentage change in price during the last X minutes. So during the last 15 minutes, this stock is supposed to move this much, dollar wise or percent wise, and it's already doing it in already done it in last 10 minutes, and 15 minutes it's crossed this much. So I pay attention to that. I need to pay attention what is going on in terms of the percentage change during the last X minute. It could be 5 minutes, it could be 15 minutes, just for my information and to look at. So price and volume filter. Another these are another alerts I get through my trading system, and you can develop in any platform, or you can have in-house. A lot of things I've developed in-house over the period. Programming is done, and you can maybe look at some system and see if these days you can find, but some are proprietary, so you have to develop. So another one criteria is opening range breakout. So opening range breakout concept is that during the first 30 minutes, if the stock has made a high, let's say the stock is making a high and low, so it's creating a range, and then you set up the alert that in this first 30 minutes it has made this low, and you set the alert, and then if it crosses this low after 7 o'clock, let's say after 30 minutes, you should get the alert that it's in the next 30-minute time segment, it's making this low, it's making a new low or making a new high. So constantly the stocks which are on my watch list, let's say in the morning, I'm constantly defining my high and lows on a lower level time frame. So on a 5-minute time frame or on 30-minute time frame, I'm constantly drawing my highs and lows on every move. So there are 15, 20 stocks, and I'm constantly defining the lows and highs, and I'm getting the alert. So when I get the alert, I look at it anytime on the stock which is on my watch list, and it makes a new intraday high. So for instance, today I was watching CME for long. So CME, when it crossed certain lines, so I decided to go long on CME. So intraday high, new intraday low. So there are stocks which are making intraday low. So they keep making intraday low. So if you're in the position already, so you're defining a low based on the previous turn. So you're looking at the full landscape on a 5-minute chart or 15-minute chart, and then you're drawing the line, and you're drawing the line that okay, if this level is crossed, I should get the alert. If this level is crossed, then I should get the alert, because you have a put position in it. So you need to you set the alert, you define the boundaries, whether to the upside and downside, and then you go and focus on other symbols, and then you define your high and lows on the range, draw the rectangle, and then get the alert. So constantly I'm doing it, and I'm getting the alert, and I'm paying attention. And if it's not meaningful, then I just I get the alert and then say, okay, it crossed 112 to the downside. So now I remember, okay, it's crossed 112. Now my new level I said is 111.25. So if it crosses 111.25, or if it goes to 112.60, then I look at it, and then I better look at it. So all day long I'm doing that, percentage up, percentage down. So if a stock is moving, if I have a position and the stock has gone up 3% that day for a reason, or down 3%, then I look at it. I start paying attention to the volume, 30% of normal volume. So if it's a 1 million on average, so I have in my database what's the average volume, and then I set the alert for 30% and above. So I get the alert above average volume. So I do all this volume analysis. So volume analysis I do thoroughly. Then this is very important for me, the resistance and support. So support and resistance. So I define the support and resistance by doing the analysis, and then so this is big for me, support and resistance. So the support and resistance, they could be minor and it could be major. So the support and resistance could be minor and major. So how do I come to know? So this is where I apply my skills, coming up with a minor support or minor resistance, or major support or major resistance, and what kind of a strength it has, how many times it has tested the support or resistance. So I get all these alerts, and then when it breaks, whether it's breaking the support or breaking the resistance, and what is the um, like the margin. So the support is, let's say the support is at 100. So that's not the support. It's just a one price 100. So it has to have some margin. So let's say 99. So between 99 and 101, when the stock is trading between 99 and 101, then I get the alert that is trading in the support zone, or it could be a resistance. So let's say Apple, okay, Apple is trading between 74 and 76. So it's trading in a very strong resistance level. The next resistance level, okay, it's between 79 and 81. So when the Apple trade between 79 and 81, I need to know. So this is the resistance range. At the bottom is the 70 71 support. So all that, the support and resistance, all day long, I am getting the alert and I'm paying attention. So how even the resistance and support and resistance alerts are too many, I have a way of cutting them down. So I don't want too many alerts. If I get too many alerts, then I will not pay attention to any of this. So I have a like a dialer. So in my system I have set the dialer that I only need to see for this symbol, and I only need to see this kind of support and resistance. I don't need to see all the minor support and resistance level. They are not important for me. So dialing it up and down and do that. Also, I pay attention sometimes to the moving average, like 50-day moving average, 200-day moving average, because the big boys are paying attention. They talk on CNBC, etc. So I do that. Now, after I'm doing all this, and let's say the trade comes. So when the trade comes, then I need to remind myself to put on the hat of a day trader, not a long-term trader. So I can have two hats. I can wear the hat of a long-term trader, or I can wear a hat of a day trader, even though, let's say I'm doing swing trading. So that's where I need to remind that I need to do the stalking. So stalking the trade is as same as um, reducing the risk. So you're reducing the risk. So it's a form of a risk control. So if you look at the definition of a stalking, so what is the definition of stalking? The definition of stalking is the essence of stalking is to find the best possible price for entry. Thus, the stalking is another form of risk control. So instead of buying, so if you do the analysis of a stock, and let's say the stock is trading at 100, so or let's say 100, and your stop loss is 95. So it doesn't matter if you buy at 100 or if you buy at 99, your stop should be 95. So it's not if you buy at 100, then you say, okay, my stop loss will go to 94. It shouldn't be like that. So if you buy at 100, the stop is already it's set at 95. If you buy at 101, the stop is still 95. You cannot, if you buy at 101 and then you say, okay, I will set the stop at 96 because I bought at 101, I can only afford 5 points. So the stock doesn't care if you can afford 5 points or 6 points. You need to pay. If you're reading the chart, then based on the chart, then you have to define the stop. So and you cannot raise your target just because you bought at 101, and then you want to make 10 points. So you say, okay, since I bought at 101, so my 10 points, it will be 111. No, it's not 111. Um, and there is a big resistance at 110, so your target should be below 110. You cannot raise your target for taking profit just because you bought 1 point late. So think of this, that these targets, when when we are entering in the trade, these are fixed lines. The target, they can change later because it's dynamic. So things are changing and you're changing the target, you're changing the stops, etc. So, but in the beginning, things are constant. So you know the target, you know the stop. Now, if you know the target and you know the stop, now how could you reduce? So stalking works in gives double the award. So how it works is, so sometime I create a slide and show you mathematically. but just let me explain. So if your entry is 100 and your stop is 95, is 5 points. So based on your portfolio size, let's say 100,000, and your risk, let's say 1%, so you're willing to lose $1,000 in that trade. So if you buy at 100, 5 points loss, meaning you can only buy 200 shares, because 200 shares, 5 points. If you hit the stop, you can buy 200 shares only. When it hit the stop, 5 points, you will lose $1,000. But if you buy at 98, so if you buy at 98, your stop loss should be still be 95. It's not going to be 93 because you bought at 98. So you say, okay, I buy at 98, so I can lower my stop to 93 because I want to lose only 5 points. So I buy 200 shares. So that's wrong formula. So if you buy at 98, your stop is still at 95. So now you have reduced through stalking, you have reduced your per share loss to 3 points. So if you have reduced your per unit loss at 3 points, and on the other hand, you have fixed $1,000 loss target, then it means you can buy 333 shares. So by reducing 1 point in your entry, instead of buying 200 shares, you can afford to buy 333 shares. So think about that. You have increased 133 shares instead of 200. You're buying now 333 shares. So let's say you bought 333 shares because you stocked it, you brought it down to 98. Your target is still at 110, let's say. So instead of from 100 to 110, 10 points, and from 98, it's still 110, 12 points. So now 12-point profit multiplied by 333. You can do the math. My phone is off. And instead of 200 multiplied by 10. So 200, if you buy at 100, so you're buying only 200 shares, 10-point profit, it will be 2,000. Whereas 12-point profits from 98 to 110 multiplied by 333, it comes to more than 2,000. So 50% more gains. So just by following and reminding yourself the stalking, not only you're reducing your risk, but you're increasing the number of shares. And when you're increasing the number of shares, overall you're increasing your profit. So your profit is going up by 50% in the same trade. So think about it, the definition of stocking, the essence of stocking is to find the best possible price for entry. Thus, stocking is another form of risk control. So there's another presentation I'll teach you about the risk control and the trading system and how much and what not. There's a formula I'll explain to you. So, but just remember, so when we see the trade, we have a choice. We can act like a long-term trader. So just jump on it. So you can do that. If you're a long-term trader, it doesn't matter. For the long-term trader, let's say I'm buying Apple. It's going to 4 billion capitalization. So I can buy whenever I want. I just buy it, or you can buy it at the right time. So act like a day trader, even though you want to be a long-term trader, long-term in that. So act like a day trader. So stock the trade. So let's say I go through all this and I'm ready to open a new trade. So how do I communicate? So in the email, in the subject line, you get this trade message. So let's say I give you an example of a long side. There's a short side also, a lot of puts these days. So CME calls. So I say whether it's a put or call. So I say CME. So CME is a symbol. Call, so call, buying calls. The month is November, 210 is the strike. And then I give you the price buying to open at 5. So stock is CME. Then in this email sub body, it describes that what is the stock symbol, what's the month, what's the strike, what type of trade it is, call or put, action, what is the action. So action is buying to open or selling to close. So one of these, buying to open or selling to close. And then the suggested price 5. And then the expiry is third Friday, unless I specify another week. So do that. So my system sends you this message. It gets delivered within a second. So especially if you have Gmail, and the Telegram just beep ting, and then you get the message. So you open your message and you execute the trade. Now, sometimes the trade may move fast and you may not, so it's not like when I'm moving the market, it's not like that. It's not that I send the order and thousands and thousands of options are getting executed. It's not like that. But what happened is when I am sending you the alert, so I'm stalking the trade. So when I'm stalking the trade, I'm looking at that entry. So as soon my message is already composed. So this message is already composed on one of the screen of on my monitor or somewhere in my system. I compose it, so I'm stalking the trades. The moment I see it, I push the button. I notice the price. So sometimes I have to adjust the price 5 or 510 or 480, 490, and then I send the trade. So the trade goes in the universe, it gets delivered to your inbox, and then maybe you're busy and you don't open it, so you can look at the timestamp and you pay attention to it. So you put the limit order, not the market order, just put the limit order and you will get filled. If you don't, then you just cancel the limit order. So after 5 minutes you just cancel it. Usually it gets filled. It's not something which runs away. I'm not a momentum kind of trader that I'm chasing the stock, so I'm not doing that. I'm paying attention to the price, and then there is some momentum there, so it's not like a dead stock. So I'm not the kind of trader where when you look at the stock and it's just not moving, so and you wonder what I'm looking at. So I'm not that. If you put my symbols on the chart, you will see clearly something is happening in that stock. So it's some consolidation break is happening, or it gapped up, or some technical reason there. So you if you pay attention to the day chart and the lower level chart frame, you would see the things happening. So I describe that in other presentation through charts. So, and then as soon as I send the trade alert, then the targets are sent to you. So when I send you the alert, I already know the targets. It's just that I have not composed it yet because I don't want you to get bogged down in the targets. So just a simple trade alert you get. Then I send you the target. So the way I define three targets. Here's the guideline to chase or not to chase. So sometimes I receive email saying, okay, how much I can pay extra. So you can pay extra if it's a Tesla, let's say, and it's trading $12, between 12 and 20, maybe you can pay 40, 50 cents. It's okay because you will make 400, 500 more. So Tesla is volatile and you can do, or it's Nvidia. So things like the stocks like that, big price, 400, 500 stock, or the Tesla kind of volatile stock. So you can pay, but if it's a trade is $2 to $4, then you can pay 10 cents maybe. So buy some for 10 cents extra, and then rest you buy for less. So you average it out. Just don't average out trade. Some traders have the tendency to feel good in bringing the average price down. So don't try to feel good by bringing the average price down 10 or 20 cents. So when you're averaging down, you're averaging it down on a meaningful way because you're increasing the exposure to that trade. So it has to have some technical reason, some reason to believe that you think of it. This trade has given you a new reason to enter. So maybe you buy at the higher price. So it is possible you bought at two and tomorrow it's trading at $2.60. So instead of closing that trade at $2.60, you ask yourself, instead of closing this trade at $2.60 and feeling good about it because I bought at two and closed at 260, have you thought of buying more maybe? And maybe not that strike, maybe another strike or another month. So add something more to it. So this thing is maturing, but other things are also, the stock is just crashing down. So instead of closing the trade in a haphazard way, remind yourself that maybe I need to add more to it at the higher price. So traders have a difficulty in adding something at the higher price because they want the same price. So if they bought at two, why pay 260? They don't forget that this 260 is going to 360 or $4. It's looking really good. So if you were right at two and you are still right at 260, so you may want to buy a little more at 260 instead of closing the trade. Or if you bought at two and now it's trading at $1.50 and is rebounding, so if you bought at $2, okay, So the things were looking good at 2. So, and it's $1.50 and it's turning around. It's not looking good. So think about that. Maybe you need to buy a little more. So when you buy more, don't buy equal number of contracts. Trader, they make this mistake also. They buy equal number of contracts. Doesn't matter what price they pay. They bought, let's say 10 shares, 10 contracts at $2, and if it's trading at $1, they still buy 10. They're supposed to buy 20. Whenever you need to have a system of averaging it down or averaging it up. So maybe write it down on a piece of paper that if it's trading at this level, I'm averaging it down. Um, I'm initiating a trade at 30% of what I intend to allocate, and then I have 70% in the back pocket. So I will take 70% of the this dollar amount allocated, and I will allocate another 30% or 40%. So this 40%, if you are averaging it down, is buying you more shares or more contract, not equal contract every time you buy. So don't do that mistake. Invest equal dollar. So so this is all about handling partial execution. If you are, sometime you don't get fill, you can try to shave the spread. So if it's trading at 320 and 340, maybe you don't want to kill the market maker by putting an order for 330, and you say, okay, the bid is 320, ask it 340, and I'm gonna bid 330, and market maker can take it or leave it. Maybe he doesn't care, just 340. Maybe you try 335. So you're happy, he's happy 335. On an up and down, little move up and down, and you will get fill at 335. So instead of paying 340, you pay 335. So in between somewhere, you set your order. So and then so once I send you the trade, then I send you the targets also. So I send you 3 targets, and there is a reason why I have 3 targets instead of just 1 target, because the trade is moving. And so if I'm going short, let's say if I'm going short buying puts, then I've done the analysis and I look at all the support levels. So there is a minor support somewhere, then there is a major support somewhere far. So if there is a major support far, that becomes my ultimate target, the third target. And in between somewhere is my, I call it green, or yellow and red. So it's like this. The concept is this, that if I start to travel from San Diego to Seattle, so if I start to travel from San Diego to Seattle, and if I put in my GPS, and sometime I put it, like after talking to you, let's say I put Seattle downtown, and it will say 67 hours. So it's assuming 67 hours that I go crazy and I drive continuously. So I will reach in 67 hours non-stop, nothing happened, and I just continuously. So that is the red target. So if I go short at 100 and the red target is 90, yes, it will reach. But in between, there will be a lot of twists and turns. So the stock just doesn't go. We all know that it creates a lot of detours. So, but if I put LA downtown, or Santa Barbara. So let's say LA. So LA from San Diego, it says 59 minutes. So I will reach 59 in 59 minutes. It's so precise. So GPS is so precise. Unless I don't listen to GPS, I make a wrong turn and then it adjusts. So it adjusts. So I arrive late, and that's what I do. I don't listen to the GPS, and I arrive instead of 1 hour, 1 hour 15 minutes. So that is LA from San Diego, and Santa Barbara could be the yellow target. So it has some stops, so some resistance in between, some support. If I'm shorting, then there is some support level. So it will stop. It will move up a little bit. There will be some short covering, and then eventually I know it's going to the yellow target. Eventually, I know I am going to Santa Barbara, even though I got lost somewhere in downtown LA. So that is the concept of yellow target. But the Seattle is my eventual destination. So that is the red target. That's where I need to stop. Otherwise, I may end up in Canada. And it happened to me one time. I was traveling in somewhere in Vermont, and then I saw a sign says Montreal 85 kilometers. So I said, oh, Montreal 85 kilometers. Okay, let me see. At least I go to the border. And I kept driving, and I did not realize that I entered in Canada. So that can happen. Keep driving in the jungle, and you end up in another country. So that's the target that I know there is a major support. I need to doesn't matter how good it looks, unless it breaks through, unless a cannonball is fired that it breaks the support in such a big way that it's going into another level, or it gaps down beyond the red target. So, for example, I reach somehow magically I reach the border of Canada and US, and then I get on the magical carpet, or I take a plane and then I fly and then I end up in Vancouver. So that's the kind of things. So when that happened, the gap down or something is happening, I send you the alert that the red target is revised or the yellow target is revised. So what is the purpose of the green target? So green target, just think San Diego to LA. It's the probability is very high that it will hit the target. The probability is very high that I will reach in 58 minutes from San Diego to LA. So it's immediate target. So assigning the probability. So what is the probability that the momentum is there, the technical is there, the news is there, the market is there. So everything is lined up. The market is bad. All stocks are crashing. There is a bad news. News coming out from politicals is all bad. Economies, this, that, and all kinds of news coming, and the stock is crashing or that sector is going down. So what is the probability of the stock hitting that target? So there is a very high probability. So the way I design my alerts is I send you the alert, let's say sell one third or sell one half. So sell one half of your position, because I don't know how many contracts you have. I get the email saying you sent the alert, but you didn't tell me how many contracts I'm supposed to buy. So I really don't know what's your portfolio size. Only you know. What's your portfolio size? What is your risk? What else is going on in your life? How many positions you have open? You just joined today. Maybe this is your first position. So whatever is your risk profile, so I'm just telling you, ideally you just sell one third of your position. So if you have 6 contracts, you bought at $2 or $3, then you sell 2 contracts. So you're holding 4, and you already know what is the yellow target, because I have sent you the yellow target and the red target. So sell one third alert is sent to the members, and in my system I document it. So in my system I know I have sent this alert before to sell one third. So I know that. Now, let's say 1 day, 2 day pass, and then the stock starts to move. So the stocks which are crashing, like puts, they go faster towards the target compared to the stock which are moving to the upside. The stock takes time to move up. The stock takes faster time to move down, because there is only one exit. So exit is one. There's only one door exit, and the entry point could be so many criteria for entry. So the guy is sitting in the Fiji island, he has his different entry point to buy. Let's say he's going long, then the guy who's sitting in San Diego, he has a different criteria. But all the guys in the world, they usually have the same criteria for exit. Just panic selling. It's just get me out of here. So the stock hitting the green, yellow, and red target in the down market is faster than the stocks going up. So when the yellow target is hit, meaning the stock has reached Santa Barbara, then the second target is hit. So there's a chance. So the way when I'm doing the analysis of the target, I'm looking at the resistance for the short. I'm looking for the support level. For the long, I'm looking for the resistance level. So that's all the turning point. So if you open your chart, so if you look at the weekly chart and you look at the daily chart, and then you have to look at the intraday level chart. So intraday level is important. So you define your time interval. You can divide the 390 minutes in a day into equal time segments, or whatever way you want to define. 395 minutes divided by 2, and or 30 minute time segment. So whatever is your time segment, if you analyze your stock on an intraday level on a big monitor, let's say 27-inch monitor, or you have a 49-inch curve monitor, you can see the full landscape of where are all the twists and turns. So figure it out, draw the lines, and that's your target. So if the stock has magically what happened when the stock is reaching a previous turning point, it does stop there for a while. It may crash, but for a while it will rest there, because there is a psychological, there are a lot of buyers and sellers, they are buried there, so they go fight. So if you don't worry about if you think you can time your entry for if you can time your exit based on the chart, based on what is happening at that moment, um, good for you. But you're better off to figure it out in advance and then set the target in advance, and don't worry about changing it, because unless you see it through clearly on a lower level chart that is crashing, and I'm better off in canceling my sell order and I can adjust it. Most of the time you're not better off, especially in option trade. If you know the target in advance, through the analysis you stick to it and let it go through, just let it go through, because magically the stock accelerate when it's reaching the target. It just accelerate and then it just stops, and then you, by the time you change and you go and let me cancel and let's see, push the button, oh, mouse is not working, or let me move the mouse, where is that mouse? By the time the game is over, and already the option which you bought at 3, which was trading at $4.20, now it's trading at $3.60, because you tried to cancel your sell order and change the mouse and all that, and your wife calling you, somebody is at the door, or you went to make the coffee, etc. So we send you the alert sell half or sell majority when the yellow target. So the reason we send you the alert sell half, when we really see there is a potential, then I send you the alert to sell half. So the stock is really is in Santa Barbara, and I know that it will go to Seattle. But if it has reached Santa Barbara and it took a while to reach there, then I'm sending you the alert to sell majority. So meaning just sell everything. You don't mind holding few contracts or few shares for the rest. And then, so we document it. So I document is what kind of alert I sent you, half or majority, and then sell rest comes later, if the same day maybe, or next day if the stock doesn't move. So sell the rest. Now the red target. So the red target is a very important target. So it's the red target is driven based on a major support or major resistance. So that's where all the turning points. So it did move. So if you look at my red target, you look at intraday, you will see, if you draw the line on the left side from the red target, which will be in the future, if you draw the line, you will see clearly there is a resistance if it's a call, there is a support if it's a put. Not exact support or resistance, because it's foolish to time, like foolish to so somebody asked me, okay, so what is your target? So if we are long, and then I just say, okay, 100. So it doesn't mean that, okay, you go and set 99.95. Okay, I set my target 99.95. No, 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 no. But 100 means that, set it at 99.10. That's what it means by 100, because 100 is just the rough number. You need to give some margin. Don't be greedy. Put 99.95 and then see it 99.85, and then I say, okay, John, did you sell? You told me 100. It's not hitting 100. Really, it didn't hit 100. Oh, it hit 99.85. Sorry, John. And he said, well, you told me 100, so it's still there. So don't do that. And maybe the 100 hits, but it's the ask which got hit, and the bid was, let's say, 99.85 or 99.90. So don't be greedy, give some margin. So the support and resistance is like a canal. It's a zone. It's not an exact price. So it's a zone. So always draw the rectangle line for the resistance and support. So try to see um, where is the range. Where is the range? So is it a narrow range or is it a wider range? So the narrow sometimes is very crucial, sometimes the wider is crucial. So if there's a wider range and you're trying to time your entry, then you have a lot of room. So think about it, your zone, where is the zone? So it's evident on your intraday chart. So if you look at the intraday chart, 30-minute chart, the hourly chart is there, all the turning points are there. So when the red target is hitting, I'm sending you the alert to sell all or sell the rest, do something. Or I'm sending you the alert that the red target will be revised. So the reason for the red target to revise is That's if it's we have a long position, it needs to gap above. So it's like you reach the Seattle, now you don't need to go through you're crossing via plane. You're taking the plane. When you reach Seattle, you're going to Vancouver, you're taking a plane. So you go the other side. You don't cross the border on a walk. You're not walking. So that exactly. So the stock gaps above. If you're long, the gaps above the major resistance. So something is happening, or the stock gaps down below the support. Something major has happened that the stock just gap down, or the stock just gap above. And once it gaps above or below, it needs to stay. It's like the river, though there is a movie called No Country for Old Man. So if you watch that movie, so there is a river somewhere in Texas, and the dog is chasing. So you better, when the dog is chasing, you go jump in the river and you're trying to cross the river. So you better go beyond the other side of the river. The river current should not bring you back to this side, because if you go back to this side, not only the dog, but the bad guy is there. He will shoot you. So the same way, when the stock crosses the red target, your major resistance, if you have a long position or if you have a short position, the stock gaps down the other side, it better stay on the other side. It doesn't come back on the same side where you were. So you need to draw the line immediately, a rectangle line, a channel, where you say it better stays. If you can define clearly, then draw the line clearly, and then the stock can trade in that narrowly defined resistance zone or the support zone. But if it's breaking, coming back on this side, then you have to push the button. So what happened during this period, when this thing is happening, this phenomena is happening, the greed sets in. So the stock, let's say we are in a long position and the stock gaps up, and then suddenly we see a big profit. The profit yesterday was, let's say, 500, and today we see 8 900, because the stock gaps up. And then it's pulling back, and it's pulling back, and then you saw the $900 profit, and now you see 800. So you cannot take 800 because you saw 900. Now it's 700. No, 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 I cannot take 700 because you saw 800. And then it goes to 600, and then it goes to 500. And yesterday you were happy with 500, and now you're not happy with 500 because you saw 900. Now it goes to 450. So you say, yesterday I saw 500. Now how can I take 450? So you wait for it, and then it comes to 300, then it goes to 200 and 100, and then it just all goes to negative. And then you say, okay, now I will wait for it. Hell with it. I will wait for it to come back 500. So it can come back to 500, but it may not come back, and it may go to zero, especially in option. So be very careful when the stock is breaking the resistance. That's where you need to pay attention and laser focus at that symbol, and decide. So I send you the alert um, as in the pre-market or during the market if something is happening like that. And if the red target is revised, let's say the major resistance is broken or a major support is broken, then I send you the alert that I need to change the target. So the target, mostly the targets are revised to the upside for the calls and to the downside for the puts. But sometimes, because there's so many things happening, the target can be revised to the downside also. So the target is revised to the downside, meaning if our target was 95, we entered at 100, now the target is only 96, because the stock doesn't want to go down anymore. It's the stock, it's doing its thing, it's whatever it's doing, is doing it, and then we need to close the trade. So I do that whether to the upside or to the downside. So, and these are the different exits. Most of the time is either selling half, selling majority, and selling all. So these three alerts are sent: selling half, selling majority, selling all. Sometimes I send you the sell 1/3. Sometimes I give you the range of the trade. So if there is a range I need to provide you, I give you the range in terms of the stock price or in terms of option. Or sometimes I send you the alert to sell by close of market, because let's say the stock is hitting at 12:30 and only 30 minutes left. So I give you the alert to sell by the market close. There is some time when the major index is hitting. So we lose this perspective. It doesn't matter what your stock is doing, and it has not reached its target. It still has its room. It will make a detour when the major index is hitting some kind of a target. So if you have a short position and the major index is hitting a support level, it doesn't matter how good your short is looking, it will turn around. It will turn around and start to move up because there is some news, some major index has hit the target. So pay attention to indexes also. If they hit, um, you will see giving back your profit in the trade. So also there's one phenomena which happen in the non-regular session, like in a pre-market or after market. Sometimes the stock, there's a news, especially so there's a news, whether positive or negative. So if you have a long position and the news comes out in the pre-market hours, earning news or anything, and it gaps up. So if you need to pay attention to your position during the pre-market hours. So if the stock is trading in the pre-market hour, if it has hit some kind of target, a high at a low volume, then when the market open, it may hit that price again one time, and then it crashes. So the target has already been hit. So that resistance level has already been hit. If the 100 was a resistance and you bought at 95 and the 100 was traded in the pre-market hours, now, if it's when the market opened and it's trading at 99, if you don't pay attention that it already hit 100 during the pre-market hour, is not and it's not moving fast and crossing the 100 level, is not going to cross. Is going down 98, 97, 95. So pay attention to your stocks in the pre-market hours. That's why it pays to wake up early and see the position. So we go through our open position in the pre-market hours, and know that we need to send you the update on the target. So I send the update on the targets. The targets are there just in case you don't have that email in your inbox or you're missing something. So you get the alert, so the gap up and the gap down. So we pay attention to the gap up and a gap down. So all the stock which gapping up and gap down are immediately looked at. And there is a process called detail monitoring and overview monitoring. So I follow the overview and detail monitoring. Overview monitoring, detail monitoring. This one goes into detail monitoring. This one goes into the overview monitoring. So detail monitoring, overview monitoring, all in the morning, the first 30 minutes of 1 hour is very crucial. So once the things are clear, then just focus on few symbols in the detail monitoring or overview monitoring. Sometimes I send you the alert to buy more in the same strike, same month, or I add to another strike. So if the stock is crashing and it has already crossed that strike and there's a more room to go, so I send you the alert to add more to the existing position, but I give you a new strike. Most of the time it's a new strike, add to the existing position, so buy more of this. So instead of having, let's say we have a 18 strike and 15 strike is looking good in the terms of puts, so I send you the alert to add more to this position, but buy 15 puts because I see that the stock is going for 15. So pay attention, like for instance, a firm. So AFRM, in my opinion, is crashing. It may go down to 12, 13 level. So AFRM. So now on the long side, let's say on the long side or on the short side, rolling up, you can roll up, buy a new strike, same month. So there are different strategy. You can buy a new strike in the same month. So if you have a November, and then you can buy a new strike for the same month, or maybe you can buy a new strike, but the month is different, or December month, or you can, when the stock is hitting a certain target, you can create a vertical spread. So you sell, you do a short call. So now you sold, you collected the premium, now you created the spread. So you locked your gains and you have a spread now. Any news update, any technical analysis update, I send you any volume update if I see it, or I just simply send you the alert that get ready to log in. This trade is approaching the target. So let's say the target is 4180 and the trade is, and we have puts and it's at 4180 and it's trading at 4210. So 4210 is trading at 42.10 and the target is 41.80. So I don't wait till 41.80. So I send you the heads up uh, and give you some range. Say, okay, the stock is approaching the target. Close the trade in this range. So I see the option range and I give you the alert. So you have enough time to close that trade. Sometimes we send you the alert to buy more. So for instance, if the original trade was buy more at 6 and now it's trading at 3, so I will send you the alert only when the technical, not just to for the reason to that you average down and feel good that, oh my, look at my average cost is down, and then you keep buying average down, fall, catching a falling knife. So I don't do that. Only when the technical reason, I give you the reason. There is a reason for to average down if we have to, or buy more at the higher price. So that's what it is. So I do give you the average down or average up in a new form, in the new strike or a new month. So that's what it is in today's session. If you have any question, please uh, send me email to success@tradegenie.com. So everything is on tradegenie.com. The monthly is 197. So go to tradegenie.com. Monthly is 197 for the swing service. All right. I'll see you on Sunday. Thank you.